Most people think you need to watch the market every day to make money. Josh learned the opposite. The more he watched prices jump around, the less control he felt over his own money. So Josh asked a simple question. If he put $100,000 into a dividend portfolio, could it generate income that actually feels stable? And what would that income look like month by month when the payments show up? Enough to cover a bill, a grocery run, part of rent, or could he retire completely without selling a single share? In this video, we'll see Josh walk through the entire process from start to finish. We'll see how the stocks are chosen, how the portfolio is put together so the income shows up on a regular schedule, and what that income actually looks like once the payments start coming in from the first month. And in the end, I'll show you how, over the long term, his portfolio could reach $2.76 million and pay him over 10 grand per month in dividend income. To understand why this works the way it does, you first have to understand the mindset behind it, and that starts before a single stock is ever bought. Before this portfolio existed, Josh kept asking a simple question. What could his money do if it had a clear job? Not something exciting or unpredictable, but something steady. He didn't want fast swings or constant decisions. He wanted money that could grow even when he wasn't paying attention. That's what led him to dividends. At the simplest level, a dividend is just a company sharing part of its profits with you for owning the stock. When the company makes money, you get paid, and that payment shows up as real cash, cash you can spend or put back to work. That reinvesting part is where things start to add up. DRIP, or a dividend reinvestment plan, means those payments automatically buy more shares instead of sitting in cash. At first, it barely feels like anything is happening, but those extra shares earn their own dividends, and over time, the income starts feeding itself. That's compounding in real life. This setup made sense because it takes pressure off. Dividends come in on a schedule, reinvestment happens automatically, and time does most of the work. With that mindset locked in, choosing the right kinds of companies became the natural next step. The approach starts by keeping things simple. The focus is on businesses that already know how to earn money, keep earning money, and share part of those earnings with shareholders. The first filter is stability. Companies with long records of steady profits and dependable dividends stand out immediately. If a business has already paid through different market conditions, it's starting from a position of strength. The second filter is dividend history. The goal isn't just companies that pay dividends, but companies that maintain them year after year. Many even raise their payouts over time, which lets income grow without adding new money. Another key factor is the payout ratio. This simply measures how much of a company's profits are being paid out as dividends. If that number is too high, the dividend may not last. Focusing on healthy payout ratios, usually below 60%, helps keep the income reliable instead of fragile. Diversification also plays a big role. You don't want a portfolio that relies on one type of business. Spreading across different sectors, consumer goods, utilities, healthcare, industrials, real estate, and even a quality dividend ETF keeps the income steadier and reduces risk. If one area struggles, another can help balance it out. And finally, you want a mix of payout schedules. Some companies pay monthly, some quarterly, and combining them helps smooth income throughout the year. With these criteria in place, building the portfolio became much clearer. When it came time to build the $100,000 dividend portfolio, Josh wanted a structure that was easy to understand and simple to maintain. Instead of spreading money across dozens of positions or chasing whatever looked exciting in the moment, he divided the portfolio into 4 clear categories and split the money evenly. 10% went into each position, so no single stock or sector could take over the results. Everything pulls its weight, and the income stays balanced. The first category is dividend ETFs. This gives instant diversification across many strong companies and helps stabilize the portfolio. It lowers risk without sacrificing income and keeps things steady when individual stocks move around. Next are blue chip dividend stocks. These are established companies with long histories of paying dividends. Their businesses don't change much, their earnings tend to be consistent, and they keep paying through different market environments. Giving them equal weight adds reliability to the income stream. Then there is the REIT category. Real estate investment trusts generate high income because they're required to pay out most of what they earn. Since many REITs pay monthly, giving this category its own 10% slice helps smooth out the timing between quarterly payouts. It keeps the income flow feeling more even, which is helpful when you're tracking results month by month. The final category is growth-oriented dividend stocks. They offer smaller dividends today, but have room to grow their payouts over time. By spreading the money evenly across these 4 categories, the portfolio earns income now, stays diversified, and still has room to grow. But even with a solid structure, there are a few mistakes that can quietly weaken a dividend portfolio if you're not paying attention, and that's where things can start to go wrong. When you're building a dividend portfolio, a few mistakes can quietly hold you back, even if everything else looks right on the surface. One of the biggest ones is chasing high yields. A stock offering an unusually large dividend can look tempting, but a high yield often signals trouble. If a company is struggling or paying out more than it can sustain, that dividend may disappear just when you start relying on it. Another common mistake is expecting every stock to pay monthly. Most companies pay quarterly, and that's normal. The key is understanding their schedules so you aren't surprised when some months pay less. That's also why having at least one monthly payer helps smooth things out and keeps the income flowing more evenly. A third mistake is not diversifying properly. Putting too much money into one sector, whether it's tech, utilities, or real estate, can make your income unstable. If that sector slows down, your dividends slow down with it. Spreading across different types of businesses can make the income steadier and the portfolio more resilient. And finally, many beginners take their dividends as cash too early. When you're still building, reinvesting those payouts through DRIP makes a massive difference. Those small additions grow into more shares, and more shares grow into more income over time. Now that the foundation and structure are clear, here are the exact companies inside this $100,000 dividend portfolio and the role each one plays. The first part of the portfolio is built around SCHD, the Schwab US Dividend Equity ETF, which carries a yield of about 3.75%. SCHD filters aggressively for financial strength, sustainable payout ratios, and consistent cash flow. That strict screening removes weaker companies and leaves you with a basket of high-quality dividend payers. Because it spreads your money across different sectors, SCHD acts as the portfolio's anchor, steady, predictable, and strong during market noise. Next are the blue-chip dividend stocks: Procter & Gamble with a 3.03% yield, Coca-Cola 2.9%, PepsiCo 3.93%, Johnson & Johnson 2.6%, and AbbVie 3.1%. These companies earn their place through consistency. Their products, cleaning essentials, beverages, snacks, and medicine, are used in every kind of economy, which keeps their earnings stable. PG earns household reliability, KO and PEP give global consumer strength, J&J delivers healthcare durability, and ABBV adds a higher-yielding pharmaceutical edge. Many of these companies have raised their dividends for decades, and that upward trend helps your income grow automatically over time. Then comes the REIT portion, built around Realty Income, known for its monthly dividend and a solid 5.67% yield. Realty Income leases properties to dependable tenants, which support one of the most consistent payout histories in the market. Because it pays monthly, it fills the gaps between quarterly dividends and keeps the income flow feeling smooth. The final group includes the growth-oriented dividend stocks: Air Products and Chemicals with a 3.1% yield, Nexstar Media Group with a 3.76% yield, and Consolidated Edison with a 3.55% yield. APD brings industrial stability and long-term dependability. NXST offers media exposure with higher yield potential backed by strong broadcasting revenues. ED adds utility reliability, which tends to hold up well during market downturns. And with the full lineup revealed, let's see exactly what these companies would pay month by month across the entire year. Dividend income never arrives in perfectly equal slices, so the easiest way to understand the pattern is to look at how the payouts naturally fall throughout the year. January, April, July, and October form a steady base. These months are anchored by Realty Income's monthly payment. It delivers $47 every single month, no exceptions, which gives each of these months a reliable starting point. On top of that, Procter & Gamble adds $76, Air Products and Chemicals brings in $78, and AbbVie contributes another $78. None of these payments stand out on its own, but together they create a dependable income that shows up consistently. Then we have February, May, August, and November. Realty Income still delivers its $47, and other holdings step in. Nexstar Media Group pays $94, Consolidated Edison adds $89, and Johnson & Johnson contributes $65. Then come March, June, September, and December. Realty Income pays its usual $47, but now it's joined by SCHD at $94, Coca-Cola at $73, and PepsiCo at $98. When you zoom out and combine everything for the full year, this $100,000 portfolio generates $3,544 in total dividend income. Spread across 12 months, that works out to about $295 per month on average. For Josh, it doesn't replace his job or anything. It can cover a utility bill, a phone plan, part of groceries, or be reinvested without him feeling it. At first glance, that number can feel small for a $100,000 investment. About $295 per month isn't life-changing, but this portfolio isn't built for instant results. It's built to grow. What matters isn't just the $3,544 it pays in year one, but what happens when every dividend is reinvested. Each payment buys more shares. Those shares generate more dividends, and over time, the income starts compounding on itself. Here's what the projections of this portfolio over the long term show. By year 10, dividend income grows to roughly $10,000 per year, or about $830 per month. For Josh, that can cover recurring expenses like utilities, insurance, or part of rent, reducing how much he relies on his paycheck. At this point, the income is more than double what it was in year 1 without adding new money. By year 20, dividends climb to around $35,000 per year, close to $3,000 per month. That level of income can cover major living costs like housing or healthcare, giving Josh the option to work fewer hours or rely less on earned income. By year 30, dividend income reaches about $124,000 per year, or just over $10,000 per month. At this level, the portfolio can replace a full-time income, allowing Josh to step away from work entirely if he chooses. But it's not only dividends increasing. Over that same time, the value of the portfolio itself is growing too. In year 1, Josh's portfolio value sits around $111,000. By year 10, the balance rises to roughly $288,000, showing consistent progress as compounding starts to take hold. By year 20, the portfolio reaches about $870,000. And by year 30, the portfolio ends near $2.76 million, showing that most of the value isn't created early on, but in the later years once compounding fully takes over. If you could only invest in one index fund, just one, that has the potential to turn $10 into a $2.2 million portfolio and pay over $6,000 a month in dividend income, click the video on your screen to find out which one it is.